welcome everyone to Factora's December member event. I am Liz Pataki. I am Factora's community manager. I am currently in sunny Tampa, Florida. I literally just moved into my house yesterday. I would love to know where everyone is calling in from. So if you have a second, drop your location in the chat to share with us. Member events like this one are typically reserved just for our Factora members, but a couple of times a year, we do open our programming to both family and friends, so our financial education can reach even more women. So if today is your first Factora event, we welcome you. Thank you so much for being here and joining us. For those of you who don't know yet, Factora is a personal financial education company that teaches women how to invest and build wealth. We are on a mission to lead 1 million women to $1 million of net worth, and we do that through our 12-week live online investment course called the Wealth Circle. The Wealth Circle opens only 2 times a year, and that pre-sale actually starts next week for our spring 2023 cohort. So any newbies on the call today who might be interested in the Wealth Circle, you will get early access to sign up. And if you have a friend in the Factora community, make sure you reach out to them so you can get the referral code and discount. So with that, let's get into today's discussion, all about investing during a market downturn. For any of us who follow financial news, we've been hearing a lot about how the stock market is down for the year, inflation is up, mortgage rates are nearly 3 times higher than they were last year. Naturally, we are all a little anxious as we look ahead to 2023. But while we can't control market factors, we can control our money mindset and investment strategies to ensure we are well positioned. I want to pass it off to our 3 women investors who are going to give us exclusive access into their investment philosophies and how they are prepping their finances to prepare for a potential recession. If you have any questions while they're talking, just drop them in the chat and we'll do our best to answer them at the end. So with that, Allegra, take it away.
Thanks, Liz. So hello, everyone. There's a lot of people rolling in, and I'm Allegra Moet Brantly. I'm the founder and CEO of Factora. I love talking about money and investment strategies, so I'm really excited for today's conversation because I do this all the time. I do this in my personal life. I do this as a career through Factora, and it's actually why I created this company so that more women can be doing it. Honestly, candidly sharing their financial goals, strategies, investing thesis, so that we can learn from one another and do more and grow more wealth. So before we get started, I do want to share a disclaimer that I always share, and that is, I'm not a registered investment advisor. I'm not a financial, tax, or legal advisor. So none of what I'm saying today or we are saying today is to give you direct investment advice. The reason I built Factora is to teach women about financial principles and investment fundamentals and the different investing opportunities out there so that they have the tools to go out and do it themselves. So I want you to watch what it's like for 3 women who all happen to be friends talk about their money and their investment strategies, especially in light of a potential. Note, I'm saying potential. I know the news out there makes us all feel like we are already in an economic downturn, but a looming potential recession and what we might be doing differently with our money in that circumstance. So let's kick it off with this agenda. We're going to welcome everyone and give you an intro to our panelists. Then we're going to have our investing conversation, and we will save time at the end for Q&A. So like Liz said, throw your questions into the chat and we will try and save time at the end to get to as many as possible. So these are our panelists. I've already introduced myself, and I would love it if, Emily, you could give us a quick 2 seconds about who you are and what you do. Oh, wait.
I got
There we
it.
go.
All right, I'm unmuted. Haven't been on Zoom in a while. I'm Emily Eisenhart. I'm based in Austin, Texas. I am an artist. I run a creative studio where I specialize in murals, but I think the whole world's a canvas. So my creative studio has designed everything from buildings to race cars to tumblers to bikes. So I very much am a visually inspired person.
You should definitely follow her on Instagram because she will be out hiking and pick up rocks that she turns into the most beautiful rainbow. And I've never seen rocks of that many colors. So she's very visually inspiring. What about you, Steph?
Hi, everyone. I'm Steph Douglas. I am a real estate investor and co-founder of Open House Austin. We are an education-focused real estate brokerage based in Austin, Texas, but we do have agents across the country that share our mindset. We are very investment-minded, obviously, and we stress the importance of creative real estate investing. And I'm so excited to be here with Allegra and Emily, two of my favorites in Austin.
Okay, so thanks for introducing yourself. Both of you have taken a wall circle in the past, and I guess I just wanted to open it up with trying to understand what was your investing experience prior to taking your wall circle, and how did your approach to finances change afterwards? Steph, you want to kick it off?
Yes, I started investing in real estate in 2013. And then Allegra and I met in 2018, I believe. I took a wealth circle shortly after. I was really heavily, I was 100% real estate, really. I took a wealth circle and it kind of opened my eyes to paper. And before the wealth circle, I had hardly opened a brokerage account. I had, a 1% yield Roth IRA that I signed, that I can't even, it's still stuck in there. But Factora really opened my eyes, and I've grown my paper portfolio 10x, actually infinity X, since I started Factora.
What about you, Emily?
I've been in paper assets in the market for quite some time, for over 15 years, sort of when I went into college, because I had the great fortune of a dad who used to be an investment banker. So I learned about money and the power of money very early. That's not to say that I wasn't totally intimidated by it. For a long time, it felt really elusive to me, scary. I felt like I was going to mess something up. And so it's actually one of the reasons why I took a wealth circle. I joined in February of 2020, right before the pandemic hit. And that's actually, even in a very financially tumultuous time, I developed a lot of confidence around taking, a hold of my money and my finances and my life, essentially, because I have a lot of personal goals, but also as a professional, I'm self-employed. And so while that might seem very risky, I actually think there's lots of opportunity. And Steph kind of just mentioned this, but like the sky is the limit. As a self-employed person, I don't have salary ceilings. I can keep earning. So, and I guess also, I started in paper. That's my investment background, but I'm now in all asset classes. And I actually started moving into real estate, honestly, because of Factora and Steph. I purchased my house through Open House. So it is all related.
Yeah, so I've also bought a few houses through Open House. If you're based in Austin, definitely check out Open House Austin, which is Steph's company. But so for the listeners who are hearing us throw around terms like paper, business, real estate, I just want to back up a second and talk about how in the Wealth Circle, we teach women that there are three main asset class buckets that can be utilized to build your wealth with. That includes paper. When we say paper, we are talking about the stock market, real estate. You all know real estate because I'm sure you all live in a home, and then business. And all three of us happen to be business owners. But even if you don't own a business, you can be invested in a business. You obviously hear about people angel investing and being a part of venture funds. That's more so for when you're accredited, but there are retail investor opportunities to own business equity as well. All of which we teach in the Wealth Circle. So I won't get too into terminology, but I would just like to hear from both of you what your portfolio breakdown is in terms of percentages of those three asset classes.
So as I stated, I'm heavily in real estate, and I started investing in paper in the stock market once I joined a wealth circle. However, I'm still also investing in real estate. So my real estate allocation is 72%. My business allocation is 22%, and I'm only 6% in paper. And then I threw crypto in with paper when I sent these, but I'm like 0.5%, very minimally invested in crypto.
Awesome.
My breakdown is very heavily paper. So I have 70% there. I have 23% in real estate in the home that I live in. Business is 7%. And also, like Steph, I did experiment with crypto a while ago, but it's very minimal part of my portfolio, but exciting nonetheless, especially now.
Very exciting. We were talking before this call that we could have a whole separate panel call on crypto, what's happening right now in the wild, wild west of the crypto space. But we thought we would mention that we all do have a little bit of crypto investments and just show you what it is inside of 100% allocated portfolio. They only have less than 0.5 each in their portfolio. I'm a little higher at 1%. But outside of that, I'm kind of in between you both. I have 12% invested in the stock market, 40% invested in real estate, and 47% in business. This one, to be specific. So, okay. It seems like every single news source is mentioning this looming recession. This is headline mania right now. Stock market dips, crypto winters, record high inflation. And so based on this sentiment, I just wanted to kick us off with what changes you are planning to make to your stock market investment strategy, if you're planning to make any. Steph.
So as I mentioned, it's amazing that Emily's been investing for so long in the stock market. I just started, 2018, 2019. So I haven't seen a fire sale like this. So I right now have a 401k, max that out, continue to max that out. Nothing has changed there. I have a taxable brokerage account, which I've kind of accelerated my investment into. I did buy I bonds this year. And then I have an HSA that I max out every year, that I've maxed out the past 2 years. This will come up again, but I am very risk tolerant. And I'm pretty excited about this market dip because, like I said, they're on sale. And I know that the history of the stock market, it has gone down and then it always comes back up 100% of the time. So I have changed very little. But I have changed before when I was playing, dabbling in 2019, 2020, it was my first foray into the market. And so I was like, ooh, we can pick individual stocks. I have shifted completely away from that because I love just a low cost, easy index fund, just funnel automatic contributions every month. And so I have shifted almost 100% to just investing in low cost index funds, baby.
Did you sell your individual stocks or did you keep them and then just, okay, redirect?
I've never sold a stock. Never sold a stock. Rarely sell real estate.
Buy and hold. Okay. What about you, Emily? How is your stock market investment strategy changing, if at all, with this looming recession?
My strategy is quite similar, actually. I am a buy and hold person. I do not sell. I believe in riding the roller coaster. I like them as rides themselves, and the market is certainly one of them as well. And because of my time in the market, I have seen the 2008 crash. I saw a big dip in my portfolio at the beginning of the pandemic, which ironically was also as I was beginning Factora. So I was really grateful to have that as sort of a companion through all of that. But I like Steph and like many investors are very interested in low cost index funds. If I'm honest, that's the majority of my portfolio. And I have seen steady, like incremental growth throughout my entire time. And it's quite neat to look at those numbers grow over decades. And so that is my tried and true. I also do max out my retirement funds. I have the accounts I have are a SEP IRA, which is for self-employed people who run their own business. I have that. I have a Roth IRA. I have a traditional IRA because I used to have a former 401k at a company that I rolled over, and I have a taxable brokerage account. I also had an HSA last year, and I invested those funds as well. I would say in general, I enjoy taking calculated risks, and I like investing because I run my business and I'm self-employed, and there have been turbulent times in a lot of the industries that I'm working in. I have had to pull back a little bit and become a little bit more conservative, much to my chagrin. But I do that because, what I did was I paused my automatic dumps into the market. And instead I set up calendar invite reminders to look at my account every month to be like, can we put more in? And if not, if it's a tighter month on the business and I want to make sure that I have enough cash reserves, I hold off. But I guess reminders are always really helpful, even in turbulent times, so that you don't forget it or avoid it.
Totally. Yeah. So we are all clearly buy and hold investors. I learned my lesson the hard way. I cashed out of my only 401k at the time to start my first company. That was years ago. I had a whole life before finance in fashion, and hashtag regret. I would love for those funds to have been compounding throughout the last crisis and being a part of the 11-year bull run that we just saw. But I always say, and I really mean this, all financial quote unquote mistakes are just learnings. That's how you gain experience. That's how you do something differently the next time. So for the women on this call that were not invested through the last downturn, it is going to be really hard for you to be invested and keep your mindset strong during this one. So I hope you really hold on to some of what they shared about their risk profiles and the fact that it is a roller coaster ride. If you don't put capital at risk, you can't have the potential of reward. That's how it works. Otherwise, we all live in this make money, spend money system, and we don't get to grow money. So we want you to grow money. Growing money means you have to get comfortable investing and having all these different accounts that they both shared. So I'm pretty similar. I have a Roth IRA. I have a traditional IRA. I started a 401k for the full-time employees at Factora this year. I also have taxable brokerage accounts. Between myself and my husband this year, we contributed $65,000 to our paper assets. The way that we share our responsibilities for investing in our family is that I focus on the business and the real estate investments, and my husband focuses on the paper asset investing. And here's why. He actually loves to spend his time on Twitter and to read company reports. I honestly can't imagine anything worse than reading these. And he does it ad nauseum. If he was not interested in researching, especially the energy sector, he's really into energy and the potential crisis that's happening in Europe. If he was not into that, we would be almost 100% allocated into just funds, because I'm not going to take the time to do that. That's not where my interest or my skill set lies, which I just wanted to point out because there are so many different ways to invest. I think it's a really beautiful thing to understand what you're interested in, what you're not, so you can focus on that. So he focuses on our individual stock market investments, and our portfolio does look 60-40, as in 60% of our paper assets are in individual stocks and 40% are in funds. I will say, because he's obsessed with energy, we are primarily in energy, followed by materials, industrials, tech, healthcare, and consumer. But energy is actually up 62% this year compared to the S&P, which is down 17%. But I just want to back out of that and remind everyone that S&P is still up 52% these last 5 years. So I don't want you to get caught up in the individual sectors. The most important thing is that you're investing and that you understand what you're doing, which obviously all three of us just shared what we're doing with our paper assets. And since investing is a long-term wealth building approach, let's shift to talking about having cash on hand, because if our investments are tied up trying to grow in the long term and they have to ride that roller coaster, it is important to have an emergency fund or other savings, liquid and accessible, to provide peace of mind in the event of a downturn. So with that in mind, I would just love to hear from you what you're doing differently, if at all, with your cash positions currently.
I am generally being more conservative holding cash, understanding that cash is sometimes not wise in this market because with inflation, it's losing its power. I need cash for several reasons. I have a lot of personal projects, including house projects that I want to work on. I bought a really old but lovely house and it needs some work. So I essentially operate my cash into buckets. I have this, I guess, mantra that cash without a plan is a problem, but a cash with plan is okay. And so as long as I know where that cash is going to end up, I feel okay holding onto it. And any remainder that I feel comfortable investing, I do. As for my business, the other reason why during this perhaps looming recession is I want to make sure that my business is taken care of. So not only do I have a personal emergency fund, I have a business emergency fund. I feel best when I have at least 2 to 3 months of runway, and that can run between, I mean, ideally I have at least 20 to 30K in the bank that can help cover salaries, issues that come up, projects I want to pursue, my rent for the commercial space that I lease. So having a safety net is really important to me. Yeah.
Yeah, I love that. I love that phrase about cash without a plan is dangerous. That's how I feel about debt. I can say the same thing about debt. A lot of people are scared of debt entirely. I don't think debt is scary at all. But of course, if you take on a liability without a plan to play it off or for a purpose, then I think it can be scary. So I've never really heard that used to cash, but it makes total sense. So I love that. What about you, Steph?
So I look at cash on hand, since I'm a business owner and a real estate investor, in 3 buckets. So for my business, we have about 3 to 5 months in cash reserves, and it fluctuates, but that's about 150 to 250,000 in cash, which Allegra knows it's a big step for me. I have historically not had that much cash. So it's nice. It's a safe feeling, especially since we're in real estate. Real estate is usually affected in any downturn. For my real estate savings, I have 33 doors with various partners. But usually, I mean, it's very good and very wise to have, a good amount of reserves because you have property repairs, stuff like that. So we keep about $70,000 in an account at all times. We don't let it go underneath that. Sometimes it's more, and then we have an opportunity to grow and to buy something else. And then personally, since it's just me, I am pretty risk tolerant in the cash department. I don't like to keep more than $10,000 in my high yield savings. Although I did recently take out a home equity line of credit. I have $330,000 that's sitting there ready for me to use. And that's for emergencies. That's for opportunities. And we can talk more about home equity line of credit, but I think it's an amazing tool for investors, not just for real estate, not just for paper, but also for an emergency fund.
I just want to quickly have you explain what doors mean. For anyone that might not be familiar with real estate investment terms, can you explain the difference between doors and properties?
Yes. So I have 19 properties addresses, and within those addresses, I have 33 units. So there's multiple properties that I own that are 2 units, 3 units. We don't have big multifamilies. We usually deal in small, either single family or, 1 to 4 units. But overall, when we talk about doors, it's usually just means units.
So that means she has 33 either people or businesses that are paying her to rent those units, even though it's within 19 properties.
Yes,
Hopefully
exactly.
Okay.
Yeah.
And then, let's go ahead and dig into what a HELOC is. If you could explain what that is and how it can be used, I think that would be noteworthy.
Yeah. So HELOC, home equity line of credit, it's my new favorite thing. Usually, I mean, the rules are shifting at all times, which is true about any line of credit or any financing tool, but we used it on our primary residence. We bought a home and then it appreciated pretty quickly. And so you're able to borrow in the form of a line of credit between what you owe and 80% of the value of the property. So we were pretty lucky in that we had a lot of equity. So we have a line of credit against the up to 80% value. And then that line of credit is available to you for 10 years. If it's not being used, you do not pay any interest on it. whatever you choose to use, you do have to pay interest, and it is variable. So like you were saying, debt without a plan is dangerous. So we're not taking out a HELOC to buy a boat. We're not taking out a HELOC to buy, Prada shoes. It's to acquire assets or to have it there in case of emergency.
Great. Thanks for explaining that. So I also have a high risk tolerance. I think I just want to double click into risk tolerance for a second, because we all mentioned it. Basically, when you're considering your financial life, you need to understand how comfortable you are with risk. When you're investing, you're putting your capital at risk. And when you're living day to day, getting in your car, you're putting your body at risk, right? So it's the same thing that applies to your money. When you hear us saying that we have high risk tolerance, it just means that we are more comfortable with more capital at risk than maybe someone else. There are a lot of women who go through the Factora wealth circle, and they're very low risk tolerant at first until they start investing and they get more comfortable with it. I think that this is an obvious path to investing. When you gain more experience, you can take more risks because you feel more confident and better at doing that thing. So I just wanted to step out of that for a second, because I also don't keep much cash on hand ever. Even with a looming recession, I have not changed anything. The only time I changed my cash position in the last few years is my family just increased with a baby daughter. And so with that, we beefed up our emergency fund because now our life is more expensive. But otherwise, I just keep 3 months of personal, and then we try and keep 3 months of a business emergency fund cash at all times. And we actually also went and we built some relationships with 2 different banks last year and got lines of credit as a backup to the cash emergency funds in the face of a downturn next year. So it's always good to get credit when you don't need it and you don't have to use it. Okay. So the other thing that you're probably hearing here is investing has a lot to do with mindset, right? There's the experience of doing it and getting better at it, but there's also just the mindset piece of wanting to do it and being able to work through the insecurity or the unsureness of doing it. So I know a lot of people could be struggling right now watching their account values drop. So maybe you've checked in on your 401k and it's like sliced from what you saw it at an all-time high last year. I just want to remind you that until you actually cash out of your investments, your valuation is going to fluctuate, but you haven't actually realized any gains or losses, right? It's just all a potential amount sitting in an account that can totally irk your insides. With that said, how are you all mentally dealing with these drops?
Oh, Emily, you want to go first?
I mean, I said I like roller coasters in the beginning. So, I'm not going to lie, even having been a long time investor, I am still, when I look at my account, sometimes horrified. Like, it is shocking. Then I take a deep breath and I'm like, I've been here before. It's going to go up. I have made more money. Like, from what I put into what it has grown to has increased. And so that alone keeps me pacified and further excited about the growth that could come. It's also fun just doing like your, net worth calculators and like fast forwarding into the future to say, okay, if I invest this much today for this many years at this rate, like I can be X amount of net worth, by the time you're 50 or 60 or 70. I mean, we're all living longer, but I find tools like that really inspiring and helpful because they're future looking versus looking at the past. Yeah, I don't know. Mindset is a tough thing, but it truly is around mindset and what you hear to be a literal loss or gain, or, even mistakes. To Allegra's point earlier, I've made mistakes too, or, failed, but I truly do learn from them and I change my behavior after that. So it's all a gain to me.
Absolutely. I actually I love that you look at the future. I do that too. I love a compound interest calculator. It's your best friend, but I also am very put at ease by looking at the past. I mean, when you look at the history of the stock market and you see the line, I mean, it's really just, it's common sense. And if it doesn't go back up, this is weird. And this is kind of like, I'm a little nihilistic in some ways, but like we have a lot bigger problems to solve if it doesn't go back up, because that means capitalism has collapsed and we're like finding our bunkers, and which I don't think will happen, but I do find a lot of comfort in that it has always come back up, and it's about weathering the storm. And I've always known that, because since I started investing, I started investing in 2013, which was already a really long bull market since 2010, when the economy started to come back. So people were doubting me and saying, you're gonna be sorry. I was buying houses for less than $200,000 in Austin, and they're saying that it's too inflated and that it's going to crash. So just looking at like, okay, I haven't been in this market as long as you, Emily, but like knowing that it's always come back up, it puts me at ease for sure.
Yeah, I think that's why it's so important to understand stock market fundamentals. And it's why we spend 2 sessions in the Wealth Circle talking about it, because otherwise it's like this thing that we hear about all the time. There's this market, it's going up and down, and it feels really like fuzzy. Like what does that mean? But essentially, it just means the way Steph, myself, and Emily are all business owners. It's big businesses that have become public that are on the stock market. And those businesses all go out and look for customers and make money, and they want to return a profit to their investors. So it has been running since it got started, and it has been on the up and up, even though there have been plenty of dips over the long term. And that is why investing is a long time horizon, because that's what gives you the opportunity for your money to deal with any short-term volatility, like we have experienced with the stock market crash in March of 2020, when the pandemic hit the world that no one saw coming. And even if there isn't a recession right around the corner, there is something to come that will also cause the stock market to dip. And then if the world keeps running and businesses keep going, and we also want to buy products and feed our families, the goal is that it continues to grow. Okay, with that said, let's shift from talking about the stock market, where we're seeing a lot of volatility, to talking about the real estate market, where we're also seeing a lot of volatility. I mean, last year it was a red hot housing market that it was almost impossible to find a house. It was some of the most suppressed inventory we'd ever seen. And now we're seeing it start to cool. Prices are dropping, there's more inventory, but also those mortgage rates have tripled from what they were last year. So what are your thoughts about acquiring real estate at this time?
Well, I dream of someday owning 33 doors. Steph is a huge inspiration to me. I currently own 1 door. I entered the housing market last February of 2020, right before the pandemic hit, again, working with Open House. And I was all prepared to, move into real estate as one of the asset classes that I was invested in. And what I would say is, between entering the housing market, the pandemic, and joining Factora, I'm so glad about that timing, even though it was nerve-wracking at the time, because I thought way more strategically and holistically about the property that I actually wanted to buy. When I entered the market, I was like, oh, like everybody else, I want 3 bedrooms, 2 baths. No, what I ended up getting was a tiny little bungalow in a great part of the East Side in Austin that had a huge lot, because I saw potential in that. And I don't think that I would have been investor minded or thinking about the potential of a given property without thinking in these mindset, in the investor mindset. And so right now I have 1 door, but we have plans to build in the back. We can actually build a bigger house than the house that we currently have. And I'm thinking actively about, how can I turn this property into something that is income generating? Can it turn into a shorter long-term rental? Can I actually maybe in the future turn our little bungalow into something that is owned by my business or rented by my business? So I think a lot about how to maximize my current square footage.
Yeah.
Wait. I think I want to interject before our real estate maven goes with her 33 doors, because Emily has one property. I have four, which 6 doors. And so I'm kind of like the Goldilocks between you, but way closer to Emily, because 33 is so exciting. And you're also very inspiring to me, Steph. So let's let you go last. But I just want to share that I was also buying when people were saying, oh, the Austin market is so expensive. You've missed the good ones. And Steph was my real estate agent at the time. I was buying houses in some of the neighborhoods that she had bought them for just a few years before for like $200,000 less. So it was really hard to put that in perspective, because my mindset was like, oh, I am behind. And then the pandemic hit. And everyone wanted to get out of condos and buy single family homes. And I owned a few of those in Austin, and our house valuations went up significantly. And we were able to refinance during those times and take advantage of the low interest rates and the high property values. And it was beautiful. And now things are the opposite, not even a year later. So I just wanted to share that context before you take it away, Steph. Talk to us about buying in this market and just all of what you're seeing.
Yeah. So like you said, we've tripled rates and values are declining in Austin specifically, but across the nation as well. And the hype right now is it's a bad time to buy, period. That's what you're hearing, because the rates are so crazy and the payments are too high. While the payments are higher, yes, I'm seeing this as such an opportunity, because it was so hard the past 2 years. Not everyone bought in the past 2 years, but a lot of people did. And they saw 10s to 20s of offers on each house. They saw hundreds of thousands over asking price. We saw people signing appraisal contingency waivers, meaning they're going to pay for the house at that price, no matter what it appraises for. That's a really scary market, even if the interest rates are 2.5. And people were able to refinance, which was amazing. But I do think that if you're entering the market now, it's a much calmer situation. And especially if you're worried about condition of house. I mean, people were signing away their firstborn. They were signing away their right to inspect. They were signing away everything. They were going to get that house literally as is. And so I feel much more at ease and comfortable in a market like we're seeing today. And sellers are kind of getting desperate, and they're willing to make concessions. They're willing to pay to buy your rate down. They're willing to pay your closing costs. So the barrier to entry is a lot lower. While yes, your monthly will be a little bit higher, but there are ways to mitigate that. So I'm looking at opportunities. I'm looking at values I haven't seen in 2 or 3 years. I'm looking at ways that I can get the seller to, pay for my mortgage payment to be less, because I'll, buy the rate down. And not every, there's a lot that goes into this. Buying rate down is a little bit inside baseball, but it's not always, the blanket statement of it's a bad time to buy is never true. That being said, the way that I've personally pivoted since the news of a looming recession, my fiance and I bought a house in 2020, and we had plans to do a major renovation. $500,000 was going to be our dream home. We we're going to live there forever. And we, the economic conditions kind of started shifting. And I was like, I don't know if I want to take that risk. As a risk tolerant person, I didn't want to have $500K out in a year-long renovation. So instead, we did a slight renovation on that home. We took out our HELOC and we purchased another house that has a back unit. I'm looking at it right now. It's a 480 square foot garage apartment, and it supplements our mortgage. It was just a very, very safe, even though it was a very expensive house, it was a very safe move, knowing what I know about the real estate market. Anything else, Allegra, that you can think of? Did I miss?
No, I think that was all really important to tap into, especially just be careful when there are those blanket statements like it is bad to buy a house. Like, first of all, who's saying that? Do they own a home? Second of all, if that's something that's in your life goals, you should not buy a home just because of the timing.
Yeah.
You can make an excuse for absolutely everything. And so I think right now the big excuse that people are putting up is, well, rates are high, so I can't buy. but that's not true. You can buy, you can refinance in the future. And even if you couldn't refinance in the future, you should be buying based on your goals and what you're trying to accomplish. So
One more thing. So my net worth is largely, unrealized gains in real estate, and that has dropped with the values. And so it's similar to, especially Emily's stock portfolio. I'm seeing values drop, but am I trying to sell any of those right now? No. So does that affect me at all? No. So like the house that we just bought that I'm sitting in, it's beautiful. It's one of my first houses that I bought that was already kind of done. And we could not sell it for what we bought it for right now. It was, full disclosure, full transparency, we bought it for $1.3 million. And we could probably sell it for 1.1. I don't care about that though. That I know that it will continue. I know that the values will get back there, and I'm not trying to sell right now. So that dip in value does not affect me.
I think that's really important to touch on. Basically, the reason that Steph doesn't have to feel like she's underwater is because technically the valuation is down, sure, but her plan is not to sell this house for a long time. And she has confidence that the market will rebound by the time she does. So that just doesn't affect her. That's another excuse we see people saying. It's like, oh, but the house market was hotter last year, so I should have bought then, and then I didn't. Again, it should just really be dependent on your goals. And right now is where there are a lot of opportunities in the market. So with that said, I am looking to pick up another real estate property in 2024. So right now, I'm just getting prepared for that. And I will do that regardless of what the rate environment is in 2024. Wait, so any other thoughts on real estate at this time, like switching up your strategy, Steph? I know that you were really bullish on just buying everything that was on the market. Are you kind of in a holding pattern right now? Where are you at with, so we talked about buying in this market. What about selling or just changing strategies?
Yeah. So, it obviously depends on your life situation, but selling is not ideal right now. If you have to sell right now, think about other options. Or if you feel like you have to sell, think about renting it out. Think about we always tell people when they're buying real estate, you need a plan A, B, and C. So shift to those. If you absolutely have to sell, make sure that it's in a really good condition, all of that stuff. I would say, I'm always kind of against selling, which is tricky as a real estate brokerage owner, but we focus on buyers anyway. If you're buying, I would say just get ready. Like you're saying, if you're trying to buy in 2023 or even 2024, you're going to see a lot of stuff come on the market, and you might want to jump on it. There's going to be really, really interesting opportunities. In the past 2 years, if you saw something interesting or unique or beautiful, you knew for a fact, like it didn't even clock us because we knew it was going to be gone in 2 days. Now you see beautiful listings in amazing locations, and it will probably go for under asking. So think about that when you're thinking of like, what kind of real estate do you want to own? If it's your primary residence and if you wanted to get into this location for the past 3 years and you thought, well, it's too late, I'm priced out, now could be a really, really good opportunity. And there's products out there. There's a 2-1 buy down that lowers your rate by 2% for the first year, 1% the next year. And then you're kind of betting on the rates going down. However, if they continue to go up, you'll be happy that you bought at these rates. So you kind of have to play with that idea.
Yeah, that's true. We did an analysis looking at mortgage rates over the last 50 years, and there have been plenty of times where they've been at 7, 8, 9, 10%. My husband's parents bought with a 12% mortgage rate their first house. So we're still well under that. And, things are cyclical, just like the stock market is cyclical. So are mortgage rates.
Yes.
The last 2 things I wanted to say about real estate was when you just said, if you are buying, buy with an option A, B, and C. I think that is really important, and it kind of goes hand in hand with make sure that your real estate agent is investment minded. Purchasing real estate is some of the most expensive purchases we're going to make in our life. So definitely just make sure that your real estate agent has the experience that can give you some of that optionality and considerations. And then the last thing I would say is to Steph's point about getting prepared now for a later purchase. there's things you can always be doing to be prepared to be a quality buyer, like keeping your credit score up, making sure your debt to income ratio is low. So we go through all that kind of stuff in the Wealth Circle as well, but I just wanted to touch on a few.
Yeah.
I also chime in about real estate, because as you two are talking, I'm realizing that some people on this call, you might already own property, you might aspire to own property, you might just not want to own property. I think for me, I really wanted to own a house, and I'm so glad that I had an investor-minded real estate agent helping me. I'm glad that I had Factora, because even if I didn't end up purchasing, and I'm glad that I did, I learned so much about it as an opportunity. I mean, even on this call alone, I knew what a HELOC was. I have not activated one yet, but I'm sitting here several years into owning a home in the Factora community, and I'm still learning from Steph. And so I think what was cool for me about going through Factora is you learn about all the classes, you figure out which asset, will work for you, which ones you have, which ones you aspire to own, and then you can make changes and you can learn more. I'm still learning on this call right now how to better maximize or strategize around what's currently in my portfolio.
Yeah,
totally. I'm still learning too. We're all learning, because the other thing I love to say is that as long as you're living, you have the opportunity to be wealth building. And so I plan on doing that forever. So there's going to be additional tactics and strategies and information. And then also, like Steph mentioned, things are going to change with the financial instruments that we have access to. So just keeping abreast of it, it's smart to have a community that you can discuss this stuff with.
Yeah. I'm not going to go long, but that's the thing. Community. If you're around people, there's not any black and white. If you're around people who are doing what you want to do, investing, real estate investing, stock market investing, I've learned so much from the Factora community, and it's not about one-time learning. It's about the continued community.
Awesome. Okay, let's shift to business, because we are all business owners, and that is the highest risk, but potentially highest reward asset class. Just to double click into that, you guys have all heard about really successful businesses like the Facebooks and there's a lot of tech companies that we have seen get venture backed and then IPO, and that has been really successful for the people who invested in them. So you can invest in a business that isn't yours, or you can invest in a business that is yours. And what's cool about a business that's different from a salaried job where there is a ceiling, there is no ceiling in business. As long as you can grow your business, then there's infinite potential return. There's also that high risk where your business might not work out. A lot of businesses that get started don't work out. And for all the Facebooks and the tech companies that you do see, there's plenty more that you don't see. So with that in mind, in addition to bulking up your emergency funds for your businesses, are there any other preparations you're making in light of a looming recession? Steph.
Oh, me. Sorry. What am I? Okay. Yes. So, as far as our business is concerned, obviously, again, real estate, we are way more focused on revenue generating activities. We're not really taking on extra projects. I think that's a big thing that you and I, Allegra, have both kind of realized in business. We have the same arc. We started our business at the same time. Really focusing in and getting clear on what exactly brings your business money is really important. So beefing up our reserves and focusing in on what really matters in your business. Oh, and sorry, last thing, I do feel very, very lucky that I bet on myself, that I am a business owner, and I know that I have full control of my income. Whereas, I don't necessarily wouldn't feel as comfortable betting on someone else and being dependent on someone else.
I am totally in Steph's camp too. I bet on myself. I'm really excited about all the growth that could happen. So while simultaneously wanting to make sure that my business as it exists now has appropriate cash reserves to weather whatever storm might be coming, I'm also investing in myself as a business owner. I'm actually spending money on coaches and business professionals who can help me think operationally, how can I scale? What projects or products could I launch next year that could, essentially be infinite growth for my business as it grows. And so I remain really excited. I think it does come down to that mindset thing where as much as possible, even during turbulent times, I try to be abundance oriented and realize that if I'm betting on myself and there's a lot of opportunities out there, sometimes the scary times in an economy are like ripe for opportunity. There are needs that are not being met. There are systems that are broken in our world. Culturally, there are a lot of opportunities and different communities that you can get to know or activate, or different products that arise depending on the world that we're living in. So I remain very excited about this, actually.
Same. I mean, I wouldn't be a business owner if it wasn't my goal to bring value to the world. That is essentially what business owners are doing. They see a void in the market, or they see a need that they want to fill, and they go for it. We all invest in ourselves with coaching. We all invest in our businesses with contractors. Steph and I both have full-time employees. Do you have a full-time employee, Emily?
A part-time employee, yeah. And then contractors.
So we're responsible for, other people. And while it is a lot of responsibility, it is a lot of upside that like I said, it's uncapped. It's basically what can your brain figure out and how much more value can you add? And really that's how you make money. You add value to the economy. So, okay. Well, I want to make sure we have some time for questions. So I guess last question for you all before we open it up is, what advice do you have for those women on the call that have not been invested through a recession before, or are maybe just getting started investing and we might be going into one?
I think my advice is what I said, which is just keep your head up even while things get scary, and always keep your eyes open. And I would say, I'm sort of like data and emotionally driven. Like emotionally, yeah, the fluctuations are scary, but I then try to go to the numbers and be like, okay, my account has grown historically, paper assets grow over time. And so I try to hold those together. It's a difficult challenge, but I think as much as one can try to be optimistically or opportunistically wired, the better for all of your life.
Yeah. I totally agree. I think I've been hearing people threaten that the real estate market is going to crash since I started investing in real estate. If I listened to them, I wouldn't have been invested in real estate at all. So my advice is to invest in all markets. Don't try to time it, and stay invested. It's a long-term game, and you gain and game, and you don't realize any losses until you sell. And so I think just keep on investing. That's my advice.
Yeah, I don't have anything different to say. I think one of my favorite quotes is that it's about time in the market, not trying to time the market. Yeah. I've had so many people that I've talked to that are like, oh, I can't invest until after the next presidential election, or I can't invest until after the rates go down, or I can't, excuses. Yes. But all that does is keep you dependent on your income providing for your life and your future, as opposed to investing so that that income can grow and diversify and become additional income streams, which just gives us more opportunity and more abundance. So with that, I'd love to open it up for questions. Liz from my team, if you can hop back on and serve us up some good cues.
Yes. So Tiffany would love to understand how you all are each balancing acquiring real estate as well as investing in the stock market.
So for me, I'm bulking up cash for a real estate investment in 2024, and I'm keeping all of my investment contributions into the stock market the exact same. So I have monthly automations into all those accounts I talked about, my retirement accounts and my taxable brokerage accounts, and I have not changed any strategy.
I'm actually the same as Allegra, but focused more on transforming my current property into more doors.
Yeah, I would say my HELOC is a great strategy for balancing that. I'm not investing any HELOC into the market. So my, salaries and my other income, I can beef up my investment in the stock market while keeping that HELOC for opportunities that I stumble across, and making sure I factor that into my costs moving forward. But I do think that having some cash on hand, if you don't have a HELOC for a real estate investment, is important right now. So if you need that cash on hand, then maybe just keep on your automated investments in the stock market and beef up your cash to be ready for an opportunity.
Awesome. So someone asks, they have a lot of money in their high yield savings account. How would you recommend she moves that money into investment platforms, doing a set amount during each month and week until it's distributed, or something else? This is probably a good one for Allegra.
Yeah. Okay. So I love this. I saw this, Yvonne, and I saw that I have an embarrassing amount of money in my high yield savings account. It's not embarrassing. It's just not allocated yet. And that's totally okay. We're all starting from somewhere. So no shame in that game. The thing I would say is, before you can figure out how much you should be automating into an investment account, is you need to understand what your mid and long-term goals are. So you've heard me saying I'm buying a house in 2 years. You've heard Emily saying she's investing in building a property within her property in the next few years. So like, those are goals that allow us to figure out how much cash we should be applying to those goals. If you have further longer term out goals, then that money is appropriate to be invested. So it really stems from what your goals are. But there's also something called DCA, dollar cost averaging, which is what we're all doing by having a set automatic contribution into our investment accounts. This helps us not worry about trying to time the market with the highs and the lows, and just get into the market consistently. Now, that's one approach. The other approach is, if you've determined your goals and you know you don't have anything happening in the near term that you're going to need liquid cash accessible for, then you can definitely get more money invested at a faster time by lump sum investing it. We've had a lot of women go through the well circle and realize, oh my gosh, I'm sitting on $100,000 that I don't need. My emergency fund is funded. I already live in the house. I don't have any other big investments I want to make in myself that I need cash for. So let me get this bulk sum invested. And then they're figuring out, well, what should the allocation look like? What should the diversification look like? And then they can go put that money in confidently. So I can't give you a direct answer because I don't know your goals.
Awesome. Val is wondering how to best take advantage of this downturn when she doesn't have funds on hand to invest.
That's a great question.
I have a idea. Well, I would say, I mean, the way that I've accelerated my real estate portfolio, and thus, I mean, I only have my net worth because of my real estate portfolio. I started as a teacher, had very, very little cash when I started investing. So I accelerated by using partnerships. I was really, really excited about investing, but I had zero money. So I pulled in my mom, I pulled in my uncle, I pulled in friends. I was like, how are we going to get this done? Once I quit my teaching job, I was not attractive to banks. So I didn't have that. So I pulled people in for both cash and for mortgage approval. So I was just the glue, and I was the one that was like hustling to get these things done. So taking advantage of opportunity in the real estate market, it's such a low barrier to entry, especially if it's a primary residence. But if you're willing to do the work, do the research, other people will trust in you to, shepherd their money, and you can be mutually beneficial.
Yeah, I think that all strong partnerships have these 3 pillars: time, talent, and money. And so if you don't have money, do you have time or talent? Vice versa. And that's kind of what you heard Steph talk about pulling in for real estate. I think when it comes to stock market investing, there's never too little to be investing. So what can you cut out to maybe repurpose to your paper assets? We go through a lifestyle analysis in Factora that is always very illuminating, because a lot of people don't know exactly where they spend their money. And then we figure out what our values are and use that as a filter to make sure we're spending where we want, and we're also considering our future needs, so that you can get more money directed. Even if it's $50 more a month, $100 more a month, every bit counts, because if it's invested, it has the opportunity to compound and grow.
So we are at the top of the hour. Do you want to wrap
Take
things
one more question,
Okay,
and then we'll wrap this up.
So how would you approach a salary negotiation during a recession?
Oof.
You all are business owners, but any tips you might have from friends or anything that you've heard?
So I used to be a salary negotiation coach. So I could go for years about this. The very quick thing I will say is get on salary.com, glassdoor.com. Make sure you understand what the range is for your experience, the job you're in, etc. If you are at not the top of that range, you should already be asking for a salary increase, regardless of the environment. And we have so many materials that can help with this inside of Factora. I feel bad. Does anyone have any like tidbits that they want to ask? It's kind of open-ended.
No, I don't, yeah, no.
Always ask for more money. If you haven't asked for a raise in a year, you should be doing it anyways, regardless of the environment. You are 1 year stronger and have more utility and knowledge about your company. So I'll give you that, and then come to Factora because we talk about salary all day long because we want every woman to be making the most money that they can possible. Before we wrap it up, I just want to thank our wonderful panelists for coming and sharing an hour of their time, letting us look into their financial trunks and giving us so much good information about what they're doing with their money and what they're not doing and how they're feeling about a looming recession. I feel like the consensus here is just keep investing regardless of market conditions, which speaks to the whole idea of we've got a whole lifetime to build wealth. So we never want to stop and go in hiding for years. We want to take advantage of opportunities when they're available. And right now the stock market's on sale, houses are on sale, businesses are on sale because they're in the stock market. With that, I do just want to mention that the Wealth Circle is opening for enrollment for just a sneaky pre-sale next week. So if you are interested and you're on this call, you will get more information about that. But it's our 12-week live course and community where you can become a confident female investor. So thank you everyone for joining us today. And thank you, panelists.
Thanks.
Hey, thank you. Thank you for having us.
Bye, everybody.